Hey everyone, thanks so much for joining today's video. My name is Jeff. I'm the head of marketing here at A2X, e-commerce accounting automation software for the world's leading Shopify, Amazon, eBay, Etsy, and Walmart sellers, as well as their accounting partners. And speaking of partners, I'm joined today by Richard from CronosNow, e-commerce accounting and inventory experts, as well as Jason from GW Partners, exit and valuation experts. They're both here today to talk to me about a topic that is either at the front or at the back of the minds of most e-commerce business owners right now, which is how to think about continuing to fund their business, whether it's through their own cash flow or when it might be time to think about selling the business and what the implications of that might be and what to expect from a valuation standpoint. Now, I know that there are other options, whether that's lending or potential investment from third parties, but we're going to focus here today on these two outcomes. So it's cash flowing your business or potentially selling your business. These guys are experts, so I just want to say, Jason and Richard, thanks so much for joining me today and lending your voice.
Thanks, Jeff. Appreciate it, man. Glad to be here, man.
Yeah, it's good to be here and good to have Jason on the call as well. We've had a long relationship with A2X and GW Partners, so it's good to get the two leaders in the room.
Jason, I'm going to start with you. I mentioned earlier that this is a topic that is either at the front or at the back of the minds of most e-commerce business owners. Do you mind letting me know why most people are thinking about this? And then we can jump into kind of what they need to consider when they're deciding which path to take.
Yeah, well, I think as far as the why, I mean, I think as a business owner, right? Usually you're aiming for some outcome, right? It's either going to be some exit at some future point, or you're building your business to generate, personal income for a certain type of lifestyle or your personal goals. So usually you're building your business for one of those two reasons, at least from a financial goals standpoint. And I think the the real important factor for trying to kind of decide, do I keep running a business, cash flowing a business, or do I potentially sell a business, is to actually understand first and foremost, have an actual, personal financial plan that is comprehensive, that covers all parts of your life and how the business fits into it. And then, if you fully understand and have that plan, it allows you to be armed, with the right information to make the right decision.
Love it. Love it. And speaking about having the right information to make the right decision, Richard, do you mind talking to me a little bit about how factors reflect in practical financial terms?
Well, I think in practical financial terms, you're thinking about whether you're getting cash flows every year for a couple of years or whether you're selling and exiting and getting more of the economics today. I think a big part of this is the emotional component, right? And I think through everything that's been happening in the last few years, our founders have been through a bit of a wild ride. And the problem is a lot of people rush to wanting to exit because they want to get out. But if they don't have some type of idea of a plan, then they might make poor decisions up front, right?
Yeah, and a lot of it feels like it's setting themselves up for success for when the right time does occur, right? Things are so uncertain, especially as it relates to tariffs right now. Like I can't tell you, like if we say something today, by the time we publish the video, the rules of the game might change, right? And we can't say that these external factors don't influence or impact somebody's decision on whether to continue running the business and cash flowing it themselves or to sell it. But the important factor here that I think we're going to get into next is being prepared for the right moment. And a big part of that is having solid financials. Jason, do you mind talking to me about like when you are valuing a business, what type of financial documentation you think is important to have in place to understand what somebody could potentially get for their organization?
Yeah, I mean, I think it starts with, the basic kind of most basic foundational item is just going to be really good accrual bookkeeping, which allows you to produce, accurate income statements, balance sheets, and cash flow statements. That's the foundation upon which any valuation is going to be built. And so if that's shaky or, it's not properly constructed, then you've built it on effectively, a shoddy base. So it will likely fall apart under scrutiny. So I'd say that's first and foremost. So it goes all the way down to your basic bookkeeping and just making sure that the accounting is actually accurate, it's accrual based, and that the statements that come out of that are reliable. That's first. I mean, there's a lot of it, but I'd say that's like the fundamental basic first thing.
And then, Richard, I have a question, kind of a curveball here, but as an accounting firm owner, you get to see tons of e-commerce businesses, right? How many that come to your door have what Jason kind of needs to create a clear financial picture?
Well, by the time someone's coming to us, it's pretty much zero of them, right? Because we kind of specialize. We work with Jason and as one of kind of the leading e-com investment banks. So Jason's investments and clients are going through some type of due diligence, right? So, or they're in the process of being incubated towards that. So the reality is most founders don't value their accounting because they don't understand it. So they've either got cash basis or they're just specifically the cost of goods sold is a mess, right? That's really difficult to do right. We're kind of specialists in fixing the COGS component. So most people have gone somewhere else. They're doing cheap, low-cost accounting, which is good enough for a tax return. But by the time they're thinking about an exit, they realize now they need to get their figures corrected, right? So we're in a bit of a situation that most people are coming to us because they want to exit and their accounts are a mess, right?
Got it. And then from an accounting perspective, how do you set them up to appropriately calculate things like true cash flow, COGS, so on and so forth, so that they can kind of meet the needs that Jason and team have to be able to appropriately evaluate their business?
There's two main things, right? So let's talk about revenue, first of all, sales. Founders, specifically if they're multi-channel, their Shopify store often has everything else plugged into it. So they'll have their Amazon, their Etsy plugged into the Shopify store, and they're often double counting, or even worse, only counting cash flows. So, for us, that's where you guys come in. A2X is the leading tool in the market to really pull out the revenue and put it in the correct periods as well, right? Not just when it's paid. Takes a bit of setup. The second thing that is a bit more complicated is cost of goods sold. And again, A2X has a kind of standard costing approach where you can put in a good landed cost per unit, and that helps get a good enough accrual number. For some of the larger, more complex kind of multi-channel sellers, you do need an inventory system as well, right? If you don't have that in place and invested, you're going to have troubles getting that data correct.
So the TLDR here is, before we can even get to a decision around whether to continue to cash flow the business or when and why to sell, it's really clear that you need accurate financials, accrual-based accounting, all of your financial statements in order, profit and loss statement, balance sheet, cash flow, cost of goods sold. But Richard, I'm going to pass the mic over to you, and I'm going to ask you a relatively simple question. It's like, now that you have kind of this structure in place, how do you start to consider the two paths that you have ahead of you?
To just restate the two paths, this cash flowing a business, what does that look like versus an exit? So in an exit, you get a big chunk of money in one time, maybe it's a bit of an earn out. But with cash flowing the business, you're looking at either 3 to 5 years, and then looking at how much money you get every single year over the next 5 years. You got to look at those numbers all after tax. And then over the next 5 years, $1 in 5 years is not worth $1 today. So you need to discount that to today's money as well. And then you get a nice numerical basis of what's the next 5 years worth of cash flow compared to selling today. And it helps give you a framework. But what you said is, you need your financials and your accounts, high quality accounts in place. Otherwise, you've got rubbish in, rubbish out for that decision, right? If you don't have the correct data, the decision is very flawed.
Well, it's hard to make a decision. It's hard to know how much cash flow you're projecting into the future. It's hard to know what the actual value of your business is. Like, Jason, speaking of valuation of a business, how do you use all of these financial statements and information to understand what a business is valued, so they can understand the other side of that coin from a decision standpoint? Like, if they were to sell today, what could they actually get for their organization?
Sure. Yeah. Yeah. I mean, some of the key components that go into that valuation process are, things like, most recent trends in revenue, margins, EBITDA, which is earnings before interest, taxes, depreciation, and amortization. For those in the audience that aren't as aware, that's probably the single most important metric for valuing a company, typically of the type that we work with. So, a multiple of EBITDA is the kind of valuation methodology most buyers will use, with a lot of other data, let's say, around that would influence that multiple. So everything again from growth rates of both revenue and margins, profits at kind of every level of the income statement. So that going back again, having all of that information correct is critical to being able to show, okay, well, this is what the business has done in the recent past, even all the way back to its inception. And then, of course, projecting out into the future, because ultimately that's what a buyer is buying, right? They're buying the future. They're using the past to help them get comfortable around predicting the future. So, kind of as Richard said, you've got two things we're doing here that are both future based. We've got future cash flows. What if I just keep the business? What's that worth? And then I've got, a buyer who's going to try to, value the future of this business and put a price on it.
You're also taking a little bit of risk off the table if you choose to go down the sell route as well, right? Because
Yeah,
I'm
you take risk off the table. Well, there's two types of risk, right? I think a lot of people, when they think risk, they only think downside risk. But yes, you take upside and downside risk both off the table. So a lot of times that decision, I think it's a very good point, Jeff, because I think that decision is often based in an owner's confidence in the future, right? So the more confident they feel about the future, and the more positive they feel, a lot of times the less likely they are to consider selling the business.
It's also interesting, like from a timing perspective, right? Like there are certain, macro conditions that make, buying and selling not the right time or the right time, but having all of these things in place sets you up for success when you potentially want to pull the trigger, right? Which I think is an incredibly important factor. Jason, I do have a question. We're April, as mentioned, April 25th. A lot of uncertainty in the e-commerce space right now. Sentiment wise, in terms of like from a M&A perspective, is now a decent time, or would you recommend that people wait? Like, what's your general feeling?
Yeah, I mean, that's a good question. I think the answer to that question has been similar over the last 3+ years, which is it's very specific typically to a particular founder's situation. There's not really one blanket answer that really applies to the majority of owners. So, you're right. There's a lot of uncertainty. I'd say generally speaking in the M&A environment, two things happen in periods like this. You get a lot of people that just hit the pause button because they want to just stop and wait and see, let the turbulence kind of simmer down before they make any big decisions. And then also you have people that are looking to be opportunistic, look for things that are mispriced, that happen to be available for sale. So they're bargain hunting a lot of times. So where it gets difficult is if you have a really strong business and you're wanting a really premium valuation because you believe you deserve it because of the quality of the business that you've built. Periods like this are difficult for those kinds of owners to really, I think, get what they're looking for. But there are lots of other situations out there where it still makes sense for a seller potentially to exit the business for a variety of reasons.
And that's one of the beauty of having good cash flows right now, right? You're effectively buying yourself time to make a decision over the long term.
You are. And then one of the flip sides, which is often not really talked about, is in a period where, say, is disruption and you have a larger percentage of businesses that may be hitting more negative trends. If you're one of the businesses that's not doing that, you stand out, and all of a sudden you look much more desirable because compared to the mean, you actually separated yourself even more. So all of a sudden it's like, well, wait a minute, now I'm there's kind of that scarcity value there that can kind of counterbalance a little bit.
So, Jason, you talked about EBITDA multiple as being one way to evaluate a business. I know that this is an impossible question. Uh, changes depending on a multitude of factors. But like, what multiples are we seeing in market today?
Yeah, and I think I would say this. I agree. It is an impossible question, but I'm not afraid to answer it. So it's historically and continues to be a little bit based on size. I think that's one point that should be clear to the audience. It's kind of I always sort of tend to categorize. You've got the kind of 0 to 10 million of revenue kind of grouping, and then you kind of have that 10 to 50 million, and then you kind of have the 50 million plus. So I'll start with the smaller end, the 0 to 10. I think for the businesses that do transact in that world, you're typically seeing things around that 4 to 5 times EBITDA kind of neighborhood for good quality. And again, that's a bit of a subjective term, but for kind of that upper quartile type of business, that's certainly from the peak in 2021. That's down probably at least 35%. And in a lot of cases, there are businesses that frankly are just not sellable now that would have been sellable back during those kind of real big COVID kind of frenzy days of e-com business sales. So that's the short answer. And then when you start to go up in size, the multiples tend to go up from there. And then even with the largest private sales in the middle market and large middle market, we're seeing the ceiling being kind of in that high single digits to low double digits kind of neighborhood of a multiple of EBITDA.
Nice. And then, Richard, how do other dimensions, like inventory as an example, factor into valuation in your experience?
Well, I think it's not just cash flow is the driver of it, right? So sometimes you got to check which multiple we're talking about. Are we talking about a multiple that includes inventory, or are we talking about an EBITDA multiple plus inventory, right? We've all been on websites where people are talking about an 8 multiple, but was really a 2 multiple plus inventory for some reason. But EBITDA is trying to be a predictor of future cash flows. For guys selling smaller businesses, they'll often use the term seller's discretionary earnings, SDE. The guys who are selling $1 million business, right? But you're trying to figure out what the return is as an investor in that business. So if you're buying something at a 4 multiple, you're expecting to earn 25% return year on year, right? Now, I think what's really important to note is that there's a big risk factor in how big or small that multiple is. So if you're an Amazon-only business and you're smaller, there's a high risk that it's not going to work out, right? So you might get a 2.5, maybe a 3 multiple. But if you're multi-channel and 60% of your sales are on Shopify with your own website and 70% of that is subscription-based revenue, well, your multiple is going to be higher because you're lower risk, right? Less chance of it going wrong. The adjustments for things like inventory, sometimes, Jason, you can correct me if I'm wrong, but sometimes we've seen guys who sell, but the buyer wants you to keep 3 months working capital in the bank, and you usually want to exclude any financing that's on the balance sheet, right? So you're selling the business, they must go sort out their own financing afterwards. But it's important to note that you got to chase earnings, but you also need to think about the riskiness of your business in order to drive up multiples and drive up value.
I mean, you guys work with tons of e-commerce businesses. You get a window into their financials, you talk to them. I'm positive that you could very quickly make a distinction between whether they should continue to cash flow the business or whether they should sell the business, like right away. What is that? Well, first and foremost, is that true? Like, can you guys quickly kind of come to a conclusion on what path to take?
Yeah, I mean, yes. Fortunately for the clients, that is true. So we can tend to kind of pretty quickly give them, I think, a really good assessment. And a lot of times, I mean, when it comes to just the math part of it, right? If you think about, obviously, the larger the multiple, of, let's say, EBITDA, because that's what we've been talking a lot about, that the business could fetch, in a sale, the greater the chance that it makes sense to sell, right? But to be a little more specific and going down to this whole idea of, do I cash flow my business or do I sell my business? A simple example, and I know we were just talking about this earlier offline, but a simple example is with a growing business in e-commerce, usually a lot of the cash is going back into the business to invest in more inventory in particular. That's the number one, let's say, vacuum of cash in a growing e-com business. And so, you might have $1 million EBITDA, but you really only put $200,000 in your actual pocket as the founder. And again, let's say that $1 million EBITDA business could get a 3 multiple, which is kind of on that maybe lower end. So that's $3 million. Okay, so that's a three multiple of EBITDA, but that's a 15 multiple of what you actually put in your pocket. And so a founder really understanding that and saying, well, it would take me 15 years at this rate to put this amount of money in my pocket, or I can put it in my pocket in 6 months through a sale. And going through that type of, say, analysis and thinking through that, that's the kind of thing we really try to help founders understand. And I know Richard is doing a lot of the same things too. And on the accounting side, making sure that, well, we can get to that accurate number, so they're really understanding, well, these are really the two things I'm trying to compare. These are the reality. This is the reality of the situation.
Nice. And Richard, do you have anything to add to that, given kind of, well, I'm assuming that you can also have that instinct, right, to know what the right path to take is?
Oh, I think you got to be cautious when an accountant tries to give that instinct. We know the numbers, but we might not know the practicalities. I had a previous career in M&A myself, but I know how difficult it is to sell a business, right? So I've always been on the buy side. Selling a business is not easy because founders do have a lot of misconceptions about what their business is worth because they read somewhere else that someone else got 3 times revenue, like some made up number. I wouldn't say I've got the same feel for it that Jason does. It's not what we do. We get the numbers right so that Jason can work with founders, right? It's a very specialized skill. And I think Jason makes it sound easy because this is what he's done for how many years. I wouldn't say we've got that gut feel, right? But we need to be able to get the numbers correctly. And we understand the maths. I can do a spreadsheet, but I can't help you sell your business because there's not just money involved. There's also a whole bunch of emotions, right?
Yeah.
So this is a different discussion if someone is burnt out, exhausted, and hates their business versus someone who is excited about their business, but is just thinking about it from a money perspective. They're going to want a higher multiple because they believe it's going to grow, but maybe the buyer isn't as convinced. So the maths is one thing, but I think there's a lot of emotion involved in this process because it's someone's child. They've bled and sweated for this thing, right?
100%. Yeah, that's a really wonderful point. I think that brings us into like a really good segue into the next section, which is, okay, you're now talking to all of these people. You potentially have a buyer. You're going through a due diligence process. Jason, I'm really curious. We talked about the importance of accrual-based accounting, having all of your financial statements in order. Can you tell me about any stories where the accounting actually jeopardized a potential deal and what that looked like?
Yeah, actually, unfortunately, I have more stories than we have time for those. Now that being said, we certainly try to do quite a bit of work up front to uncover any issues ahead of time. And a lot of times, that will result in just a long delay, frankly, in going to market in the first place, right? That's usually where we catch things. We tend to catch it early, so that becomes like you thought you were going to go to market in a month. Well, now it's going to be 6 months because we got to fix all your accounting before we could show it to anybody. So that's one, and that happens quite often, to be honest. And then we actually had one recently where, unfortunately, there was a pretty big miss in terms of from the accountant's perspective on putting together their cost of goods. As Richard mentioned earlier, that's a place that tends to be a particular problem area for a lot of e-commerce businesses. And then we ended up having to fully restate the accounts in the middle of diligence, right? Which what happens there is now the buyer's confidence in what's been presented goes down significantly. You completely lose momentum in your deal process. And now all of a sudden your buyer is just skeptical, right, about everything. So, and then ultimately the price they want to pay now starts to go down, right? So that happens hopefully not terribly often because you're catching things up front, but it does happen, and I think that I can't stress enough how much um, you know negative things being uncovered in due diligence hurts a deal. It that those things that's what kills deals far more often than even business performance starting to maybe take a turn. Is in diligence, buyer uncovers something they weren't told about or no one knew about, and it's negative, and then all of a sudden it's a domino effect of confidence. They just lose confidence.
100%. And hey, Richard, in the spirit of, you mentioned that sellers that are doing sub 10 million are more likely bought rather than sold. And we've been talking about this idea of like, you really need to have accurate accounting to set yourself up for success, whether you're planning to sell today or planning to sell tomorrow. Like, at what point for those like sub 10 million sellers would you say it's important to get your books in order to set yourself up for future success?
So there's a cost benefit here, right? So accountants aren't free. I think there's a lot of kind of cheap accountants on the market at the moment, and accounting solutions that kind of feel automated. They're not great, but they get enough of a job done. The reality is we kind of have a cutoff internally. So if you're doing less than $50,000 a month, we're generally trying to look for a cheaper option for you, right? So we might have a bit of a light option in terms of how we treat COGS, etc. Because the variance, the differences is so small that the additional cost and all that additional work is, not really worthwhile. But I generally find somewhere between $30,000 and $50,000 a month in turnover, you really want to start taking your COGS really seriously. So just to go back to the slightly smaller guy, someone who's doing $20,000 or $15,000 a month, I still recommend a tool like A2X to at least get your revenue very accurate, right? Because the COGS, whether you're a little bit off here and there, there's not, at that size, you're not in absolute crisis mode. You can still go to a bank and get a loan if you need to. But if your revenue is just, you receive 10 grand from Amazon, well, that's not revenue, right? There's Amazon fees in there. It might be some sales from last month. And that's what's really powerful about what A2X does. Not just giving you actual revenue versus channel fees, but also getting the revenue into the correct months. And we all know Amazon takes 2 weeks per settlement, right? So if you get paid out on the 3rd of March, well, most of those sales are related to February. You need to show those in February and the few that are in March. I think it gets very important when you start crossing $1 million or maybe $3 million a year, that a lot of extra effort has to go into the COGS and inventory. But understanding that's going to, just call it even double your bookkeeping and accounting and inventory systems fee. So you're weighing up cost versus benefit the whole time.
You're going to have to pay for it eventually, though, right? Especially in the context of the topic that we're talking about today, right? Is, there's no reality in which you get to a point where you don't have to go through due diligence if you're selling a business, and they're going to want a clear picture of your financials over. Actually, that's a really good point. Like, Jason, historically, like from a historical financial perspective, how far do you guys usually look back?
Well, I think you want it kind of rule of thumb is a minimum of 2 years that you feel like really, really good about, like the accuracy, kind of that 2 years that is the minimum. I think obviously we'd rather have full history be perfect, right? But 2, I think you need at least 2, and a lot of times buyers beyond that will still want to, look at information and try to understand, well, what was the history of this business is told through the numbers. But in terms of where what's really going into their valuation models and then their, forecast prediction models, it's the last 2 years.
Nice. And Richard, I love what you said in terms of like when to start to think about it, because you've probably done a lot of catch up work in your career. That's, in my opinion, that's like some of the hardest work to do. You forget, like, it's hard to access the data. So getting on this as early as possible, even with a lightweight solution, and then, as you start to get bigger and your accounting requirements become a little bit more complex, starting to work with an accounting firm like CronosNow becomes even more important. So Jason, you mentioned, having 2 years of accurate accounting data. Great. But accurate accounting data, I think, changes depending on who you speak to, because most people are going to think that their accounting data is accurate. But Richard, you and I have been in the game for a long time, right? We've seen a lot of books. And the reality of the situation is, not two companies are alike in this area. How do you quickly evaluate if somebody actually has accurate financials versus not having accurate financials? And then how can, the people who are watching this video quickly make that same evaluation?
Yeah, I think so. I've got let's call it a party trick that I look at every new client in the first 15 minutes. I'll pull up the last 12 months or 24 months, 12 months because it fits on my screen. And what I'll do is I'll look at the total revenue per sales channel and compare it to what the Shopify or Amazon reports for the same period say. So I'll pick three random months and see if it's almost exactly the same. Shopify is always the risk. People duplicate other sales channels through Shopify all over the show. The second thing I do is I'll look at the gross profit. Defining gross profit as sales minus your cost of goods sold, the product cost of goods sold. Taking that gross profit, dividing it by revenue to get a percentage, the gross profit percentage. If I look at that month on month over 12 months, if that's not relatively stable, right, then I know that something's genuinely wrong, right, with the COGS and the inventory. The final step of that looks like it's wrong, but maybe there's a story. There was a tariff that landed, last month, and therefore we've got a big spike in COGS, gross profit changes. If there's a story, that's a different reason. But then I would finish that off by a quick look at the balance sheet. Founders are notorious for ignoring the balance sheet. You look at the balance sheet, look at what your inventory on hand balance is, recalculate what that should be, more or less. Inventory count times the cost. If that number's not pretty close, and close, I'm talking 90 to 110%, well, then your books are broken, right? Something's not working, and your numbers are just made up. So I can do that in 15 minutes for any company. And that's generally the way I will make a decision if the books are in good shape and need work, or if you can kind of accept what's in there already.
You heard it here first. CronosNow is offering a 15-minute service where Richard will, provide his party trick and let you know if your books are in order or if they're broken. Richard, I won't hold you to it.
Yeah, you joke, but we do. We part of what we do is we have kind of office hours 3 days a week where people can book, and they can book a half an hour call. We'll have a quick look and give advice where we can, right? So that is something we can do. Jump on our website and book a time. And I think Jason's got a similar approach on his side.
Nice. You know what? To that end, we'll put the link in the description below if you want to connect with either Richard or Jason and team for these office hours. That sounds awesome. So a lot of the discussion up to this point has been really around, the business owner's decision to either continue to cash flow the business or to sell. Let's assume that they've now made the decision to sell based on all the information that they have available to them, and obviously the emotional factors involved. Jason, I'm gonna ask this question to you. Like, how can, or at least what can they do to make their business very desirable for potential buyers?
Yeah, I think some of that depends on the timeline, right, that they're working with. I'd say, we work with a lot of clients, 2 years plus before we plan to go to market, and really try to guide them on how to develop their business so that it is an increasingly more attractive acquisition target. I think the kinds of things that buyers really care about, right, are going to be certainly, growth and hopefully future growth opportunities, that there's plenty of blue sky for a business, and being able to define and kind of show that those opportunities exist, even if you are the owner that doesn't want to necessarily go and actually, kind of execute on those before passing the baton to the next generation of ownership. Predictability is always highly valued, right? So, a lot of times, I think founders will chase really fast growth in a segment that maybe is also going to potentially see a fast contraction, right? So more volatility results in lower valuations. So buyers would rather see like steady upward continuous movement rather than, a lot of say fits and starts there. So I think trying to build a business that, can be predicted moving forward is key. Which usually there's diversification that's part of that. I know a lot of the audience here, we've kind of alluded to different e-commerce channels on this discussion and previously. So, having a single channel drive all of your revenue is, not as good as having multiple channels that you can kind of rely on, whether we're talking Amazon website or other marketplaces, or even retail, wholesale, for a lot of these consumer product businesses. So I think that's also really important. And, having a customer base that hopefully is somewhat passionate about what you're doing is pretty key. And usually that plays into the concept of brand. I think that's something that's hard to put your arms around a lot of times for people. Like, what is brand? Like, how do I define brand? How do I value brand? But that's something that, buyers are very, very focused on in the consumer world, right? It's like, have you built a brand, or have you built more of what I would call, a widget selling machine? Like, which one have you built? Widget selling machines are less valuable than brands. So, and typically the way we sort of define brand, one way we like to define brand is you've earned the right to have the next conversation with the customer, right? So, whether that be because they're referring you to their friends, hey, you got to try this product, or because you have other things that they now want to purchase from you. That's a good way to think about it. Is, are you building that either that loyalty or that willingness for your customer base to go out and talk about you? So those are some key factors kind of in the e-com world. And then we touched on this earlier, but supply chain has become a big focus too, right? Building a resilient supply chain, building a diversified supply chain, and that now is actually becoming a big driver of valuation as well, ever since kind of COVID plus all the tariff craziness. So those are a few, certainly.
Nice. So the TLDR sounds like predictable growth that isn't necessarily volatile in nature, decent channel diversification, as well as supply chain diversification, which is what you've added. And then all on the foundation of a solid brand where you have tons of referrals, potentially returning buyers, and kind of all the amazing halo effects that come from having a really awesome brand. Anything else, or like, cause it's interesting. We didn't talk about accounting, right? Like, and solid accounting, but I think it's a really important part of the discussion, because people aren't buying a business based on the fact that they have good, clean, accurate books, right? But it is a necessity when somebody is evaluating a business so that they can, create a picture of all of the dimensions that we've talked about previously, right?
Yeah. And I would say, Jeff, it's funny. I think you make a great point there. I would say it's so essential and so expected that I didn't mention it.
Yeah. So, well,
Right.
100%, 100%. And speaking of that, Richard, so like, it is essential, right? It is expected. How do you ensure that your clients meet those expectations?
I think it's part of a larger discussion of, as a business, if you want someone to buy you, well, design the business that the person who buys it from you will have nothing but a good time, right? So you have proper SOPs and processes for everything, from your logistics and your supply chain to how you do customer support and the accounting. Now, the accounting side, the problem is most founders don't understand what that process looks like. They literally, I've had people phone me that, like, why am I paying you? Like, QuickBooks just does it, doesn't it? No, it doesn't, right? We have that regularly. But I think a proper process where you map every single process from sales through to bank, purchases through to inventory, and keeping proper documentation is incredibly important, right? So if you have a bill in QuickBooks or Xero, well, where's the attached source document? So remember, due diligence is not just going to go, oh, your accounts look nice. They want to look at the supporting documentation and how it got in, right? They want to look at how you calculated landed cost. Well, is there a spreadsheet or some tool where that was maintained? So keeping a proper, consistent process for the accounting is incredibly important for due diligence. That's what due diligence is. They're coming to audit to sources of where that data is. And that's, again, I'm going to just give what you guys do so well, is every time you push a packet of sales data across, there's an attachment with all the payout and sales order data that's due diligence ready, right? That's very different to someone going and just putting a Shopify report and passing a journal with no attachment in QuickBooks, right?
So Jason, Richard, I've personally learned a lot from both of you today. I think this was an amazing video, and I hope it was valuable for e-commerce business owners that are, currently evaluating which path to take, whether it's to continue to cash flow their business or whether it's to, start to think about selling. I think the common theme here that we've struck is, regardless of what path you choose to take, you need to have clear visibility into your financials. You need to have accurate books, because that will set you up for long-term success, no matter what direction you take. Is there anything that we might have missed or that you'd like to emphasize from our conversation? Richard, I'll start with you, just in case we might have missed anything.
Yeah, just to say, I'm definitely a believer in keeping businesses, as that's my bias, because of personal experiences. But everyone who's ever had a successful exit that I've worked with, you realize that businesses are bought, purchased, not sold, right? The power sits on that side. So you need to set everything up today for 24 months down the line, that you have a good story to tell, you have accurate data, you have accurate documents and processes, and the buyer must be set up for success. If you don't do that, you're going to get murdered on valuation, or there's going to be no deal.
Because you never know when somebody's going to come knocking.
Or when you're going to want to sell, right? Maybe you want to go live on you win a lottery and you want to go live on an island somewhere. You don't want to have to try and fix up 24 months of accounting at the last minute.
Yeah, totally agree. Jason, anything that you might have wanted to add?
Yeah, just like kind of our recommendation, in addition to having someone like Richard and his team, on your side, making sure your accounting is great, somebody like us on your side, making sure you're understanding, what your kind of strategic and ultimate M&A options are. You need that also really solid personal financial planner on your side. And then kind of the three come together really to help founders really kind of get good, pure, visibility, clear visibility on what's the right way for this business to integrate into my personal financial goals. And so, we can all work together to make sure that founder is making the right decision for them and their family.
Love that. So thanks for watching the video. All of the resources that we've talked about will be linked in the description below. There will also be a link to GW Partners as well as CronosNow, so you could reach out to either team after this conversation. Jason, Richard, I just want to thank you so much for sharing your expertise with us and for taking the time. And then for everyone watching, we'll see you next time.
Thanks, Jeff.
Thanks, Jeff. Cheers.